How's it going, guys? Welcome to episode 5 of the Emerging Wealth Podcast, a podcast dedicated to tax and financial education for high-income millennials. We're talking all about how to get started in investing in real estate. No, not a real estate ETF or a mutual fund, actual real estate. If it's your first time here, my name is John Boyd. I'm your host. I'm a certified financial planner. I'm the founder and lead wealth advisor at Modern Wealth. That's modern spelt with no vowels wealth. We're a fiduciary fee-only financial planning firm located in Scottsdale, Arizona, but we serve clients all over the country. I'm excited you're here today. We have a real good one in store. So before we dive into it, if you haven't already, go ahead and go to the description of this episode and click on the link that takes you to our Learning Center. In our Learning Center, you can go ahead and sign up for a weekly Planning Insights newsletter. It's completely free. This is where we give tax, financial, investing, retirement planning, education, all for free. You do not want to miss it. So go ahead and make sure you subscribe. So let's dig into it. Real estate investing is an area that, to me as a financial planner, is really, really frustrating for a couple different reasons. Number one is, most financial planners or financial advisors are very hesitant to even discuss real estate investing or incorporating real estate into your portfolio. You know, if it isn't about stocks, bonds, whatever else, they just don't want to talk about it, which to me is crazy, right? Because there was a study done, I think it was a few years ago. It was a study by McKinsey that found that about 90% of America's millionaires have real estate as part of their wealth, right? And that's a big deal. And part of that has to do with the fact that real estate, through leverage, through some of the benefits that it provides, allows for really powerful wealth accumulation, right? So for a lot of professionals to not want to discuss it is absolutely crazy. Now, on the flip side of that, especially now with social media, with Instagram, TikTok, right? All these places blowing up with all these gurus that talk about real estate. There's a lot of myths, misconceptions, and just flat out just borderline fraud with some of these individuals overstating some of the benefits of real estate and not discussing any of the risks. So the purpose of today's episode is to really give you a primer into understanding how to incorporate real estate into your own portfolio, understand some of the myths, some of the benefits, and just some baby steps on how to incorporate it. So without further ado, what are some of the common myths that we see? Well, number one, tax benefits, right? So do not get me wrong. Do not get me wrong here. Real estate can provide some really powerful tax benefits. I think in a few years, right, when the Tax Cut and Jobs Act sunsets and the standard deduction gets reduced, those benefits are going to be magnified even further because more people are going to be itemizing, and you can itemize your mortgage interest on your primary residence, right? So that in and of itself is really, really powerful. Even now, that's a really powerful benefit to a lot of folks. But some of the issues lie within the fact that there is this misconception that real estate, just simply having it or simply having a rental property, equals the gateway to just utilizing depreciation and losses and just completely reducing your taxable income, right? I hear that all the time. Right? People will come, they'll want to invest in real estate. And I always ask why, right? Not to say it's bad, but I always say, hey, what's your strategy? Why do you want to incorporate whatever this is into your financial picture? And usually the answer many times is, well, I need the tax benefits, right? I make too much money. I really need the tax benefits. The tax benefits, although they're there, most people are not going to be able to experience the true, full, unlocked benefits of real estate. And without turning this into a 30-minute podcast on real estate taxation, bottom line is, unless you are, for example, a real estate professional in the eyes of the IRS, which requires a significant amount of work and time dedicated exclusively to real estate, you are not going to be able to simply deduct depreciation or losses directly from your real estate to your W-2 income, right? So if your property is depreciated $10,000 a year and you make $100,000, it's not a $10,000 loss directly off of your $100,000 of income. I mean, it just doesn't work that way, right? Now, real estate, the losses, sure, they get generated, but they're passive, right? Passive losses cannot simply be used to deduct your actual ordinary income like your W-2 income. Doesn't work that way. Now, are there strategies and ways that you can get around to that require some work? Yes. But the vast majority of people are not going to experience those crazy amount of benefits. In fact, most people that I know who have pretty significant real estate portfolios, most of them are relatively passive, slow wealth accumulation strategies. They aren't just these, they aren't investing in real estate strictly for this benefit, because bottom line is it's tough to get the true unlocked tax potential of real estate. So bottom line is, if you've heard real estate can provide a ton of tax benefits, yes, it can, but most people are not going to be able to experience the full tax benefits of real estate. Number 2 common myth is real estate equals low risk. I've always found it just baffling when I hear someone want to invest in a rental property and they just think it's easy as, well, I'm going to buy a rental property, I'm going to rent it out to somebody, and their rent is going to cover my mortgage, and I'll make a little bit of money. It's as simple as that. How hard can it be? Well, what if that tenant stops paying rent? What if that tenant leaves and you can't get another tenant for a while? What if something breaks in the house and you have to repair it? Right? There are risks associated with having rental properties. Now, this isn't to scare you and to say you shouldn't have or shouldn't explore those type of strategies, but you need to be aware of those risks, right? It isn't just as simple as, hey, I'm going to have somebody here cover my mortgage and life is going to be easy. No, it's a lot more complicated than that. And therefore, real estate investing is not equivalent to a low risk investment. It's not. I want to make that crystal clear. Do not associate real estate investing with a low risk strategy, because I see people do that. I see it happen online. People equate it to something that's relatively low risk, and that is absurd. Number 3, common myth, you need to avoid what a lot of these real estate gurus are saying online, right? I see it happen all the time. People on Instagram, people on TikTok, all these different places talking about how they're casually flipping properties and how they made all this money through real estate. And bottom line is, do some of those people exist? Sure, they do. I've seen it. But is it extremely common? No, it's not incredibly common. Are there a lot of failures with it too? Yeah, I've seen plenty. I've probably seen more people screw it up than make it big for some of these really exotic strategies that you see online, right? So take the advice that the real estate gurus are giving you online with a grain of salt. Yes, I can respect their appreciation for the power of real estate, because I know I do. But what I do not respect is the blatant, just excessive risk, not educating their viewers on those risks. And before you know it, you have folks who are clearly unprepared take on far too much at once. And we'll talk about that in a little bit. Finally, common myths, REITs, or real estate investment trusts. So REITs, if you're not familiar, without going into a full-blown lesson on them, you see them a lot in just investment portfolios, right? You might have a REIT mutual fund in your 401k. You might have a REIT ETF in your investment account or brokerage account, right? And while, yes, those have their benefits, right? And there's ways to incorporate those type of funds into a portfolio, that is not the same as actually buying real estate, right? I've seen people equate, oh, I'll just buy a REIT index fund and that gives me the same amount of exposure as actually buying real estate. That's insane, right? It's much more complicated than just simply looking at the 20-year past performance of a REIT mutual fund or ETF versus the average primary residence in your area, right? There's much more to it than just simply looking at that. So if you're someone who was thinking maybe a REIT ETF or mutual fund would do the trick, it certainly can help with diversification, but do not think that, this is on the same level as what we're talking about here. Okay. And if you had a financial professional tell you that it is, well, you should fire them. So now that we've gone over some of the common myths, why and how would you invest in real estate? So as we mentioned earlier, real estate has had a role in creating about 90% of America's millionaires, according to a McKinsey study. So there's some method to the madness here. There's a reason why we see real estate gurus and all these people talk about the benefits of real estate and ride so hard for it, right? Because there's some truth to it. There's no doubt some truth to it. But to understand that truth, you need to understand how to play the game. That is so important. If you do not understand how to play the game with real estate, you will get eaten alive. You could put yourself in a position that puts your family on the brink of financial ruin. I hate to sound all gloom and doom, but that's the reality. If you do not understand how to play the game, you're either going to take on far too much risk or you're going to be someone who's just paying cash for properties and thinks, there's some guru for doing that. So there's a balance. You need to understand how to play the game. And in order to play the game, and this is one reason why we're doing this episode on this podcast dedicated to high income millennials, is that you need the capital to play the game. You need the money. Right? If you don't have money, you can't play the game, right? You need to have money to play the game. And, I hate to say it, but folks who, are just struggling to put together an emergency fund, right? A 3 to 6 month emergency fund. Is exotic, complex real estate investing going to be appropriate for them? Probably not, right? I mean, they're free to do whatever they want, but that's going to be a lot to take on. You need to have capital to be able to play the game. And I think what's really unique about this demographic, and one reason why my firm focuses so much on high income millennials, is that this is a demographic that has the flexibility and cash flow to potentially invest in real estate and can play the game. So number one, you need the money to play the game. Number two, you need to be able to take calculated risk. Right? Real estate investing, buying real estate means calculated risk, right? Again, I cannot stress this enough. This is not a low risk investment, but it doesn't need to be a casino either. You need to understand when it's appropriate to take on risk, how much to take on, and measure out that risk and reward. Okay. Finally, and this is one of the, underrated reasons why to invest in real estate, is that it fixes your housing costs, right? This is primarily aimed at, folks who are thinking about buying a primary residence or just bought their primary residence and they're thinking about paying off their property sooner or faster or whatever, is that when you buy real estate and you have a mortgage, right? Maybe in year one, that mortgage consumed 20% of your overall household monthly budget. But over time, because that's generally going to be a fixed mortgage, and your income steadily increases every year, but that mortgage is fixed, what happens, right? Visualize that. Your income steadily increasing, but your mortgage costs stays flat. What happens is that it consumes less and less of your monthly budget. And because it consumes less and less of your monthly budget, that gives you extra cash to invest in other areas, invest in stocks and mutual funds, invest in other real estate properties, invest in a business, right? That creates flexibility, creates liquidity. And that is, in my opinion, a very underrated element that not a lot of people talk about, is how it effectively puts a lid on your housing costs to a degree. So we've talked about common myths. We've talked about why and how you would want to invest in real estate. Let's talk about the third really, really important concept if you are going to venture into investing in real estate. And that's understanding the concept of leverage. And whenever I hear leverage, I always think about last season of Breaking Bad, Walter White sitting at the table. He's like talking to Lydia, and, I think like her life's on the line. And he just says, like, very casually, like, do you understand the concept of leverage? Like, just says that to her. And that sums it up, right? Do you understand the concept of leverage? Right? Because if you don't understand the concept of leverage here, you're not going to fully understand the true benefits of real estate. Now, again, can you invest in real estate without leverage? Yeah, you can. But leverage is where the big money is made. And responsibly incorporating leverage into your portfolio, responsibly, that's the key, is where the potential big bucks are made. So to help you understand leverage, let's utilize a really, really simple example. Okay. So I want you to visualize wherever you are, if you're in your car, if you're on a run, wherever, whatever you're doing. Imagine you are shopping for a home. Okay. Shopping for a home, and you found a home. You found a home that you like. It's a $500,000 home. So you decide to put $25,000 down. That's a 5% down payment. Now, interest rates have gone up. So you end up getting a 30-year fixed mortgage at 6.5%. So your monthly principal and interest is going to be about $3,000 a month. Okay. So you bought a $500,000 home. You put $25,000 down. You got a 30-year fixed mortgage at 6.5%, which means that your total mortgage that you're going to have is $475,000. And that $500,000 piece of real estate, in this case, the home that you're going to be living in, the average rate of return per year is 6% on average, right? 6% per year is the rate of return. Okay. So what does your balance sheet look like? So you in the year 2023, this year, you bought the home for $500,000. You have a mortgage of $475,000, which means your initial investment was $25,000. That's your initial investment. Now let's fast forward 10 years down the road. Okay, 10 years later. If your home was growing on average at 6% per year, that means your home value is about $895,000. So it's grown pretty significantly. Your mortgage, assuming you haven't accelerated paying it off, your mortgage is now down from $475 down to $402. Okay, in the span of about 10 years. Okay, so it's gone down. Your investment, again, was $25,000. So when you do the math on that, you have equity, your return on the property, the equity that you have is $492,000, right? You take the home value, subtract the mortgage, that's equity of $492,000 approximately. Your initial investment was $25,000. Your initial investment was $25,000. So what's your rate of return here? So your annualized rate of return ends up being roughly 35% a year. 35%. That's crazy. 35% per year. You have effectively 20x'd your initial investment, 20 times your $25,000 investment. You flip that from $25,000 to almost $500,000 in the span of 10 years. And how did you do that? You did it through leverage. You did it through borrowing the bank's money, and you magnified the return of your initial investment. That is the power of leverage right there. That magnify effect. Because if you would have, in theory, put all your money in the home, right? You just bought it $500,000 outright. The rate of return on the home is 6% per year. So that would have been your rate of return, right? 6% per year. But instead, in this case, you got a 35% annualized rate of return. Oh, and by the way, if this is a primary residence and you're married, there's that $500,000 capital gain exclusion. So if you sold it today, that $492,000 gain is completely tax-free. That's huge. That's massive. That's massive. What you are seeing and hearing right here is the power of leverage. That is why I'm a big proponent of, if you can own your primary home and you're not going to be in over your head and you can stay in that property for some time, right, to ride out any volatility in the housing market, I'm a huge proponent of buying your primary residence if you do not already have one. Because when you own your primary residence, that is the easiest way to incorporate the concept of leverage in a portfolio, in your life. It's not only an easy way to do it, but it's a responsible way to do it. A very responsible way to do it. Again, assuming that you've done the budgeting and assuming that, in this case, you can easily afford that monthly mortgage, right? All the other things. But again, you get the idea. But here's the problem, right? So here's the problem. If you've ever seen that meme of this kid, he's like walking up the stairs and he's, decides to skip like 5 steps. And before you know it, he's like practically doing the splits on the stairs, trying to leapfrog like 5 different steps, right? That huge step. That's how I visualize a lot of people thinking about real estate. So here's what I mean by that. I work all the time, let's say with somebody who's renting, right? And they ask me, hey, I want to get into real estate. And their first thought is, yeah, I should buy a fixer upper and flip the house. It's like, whoa. It's like you're renting, right? And you want to dive into this highly capital intensive project with risk. Why don't we just look at buying a starter home, right? You don't own your primary residence. Why don't we look at doing that first, right? If you're listening to this and you do not own your primary residence and you've always dreamed of doing it, my advice to you is that primary residence, it doesn't need to be the forever home. In fact, I would encourage you to not buy the forever home right away, right? This should be the starter home, right? This is your first property. I know that when I bought my first home, the intention was that one day we're going to rent it out, right? This isn't the forever home. We're going to end up renting this place out. And while there's tons of different ways to view it, maybe that works for you, right? But the reason why I say that is that buying the starter home, one, presumably isn't as capital intensive, doesn't require as much money out of pocket. You can put, let's say, 5% down, and you get to experience, hopefully, some of the benefits of leverage, perhaps itemizing some of the deductions associated with the mortgage interest, right? All these little benefits that come with real estate, you get to participate in to a degree when you own your primary residence. Now, if you own your primary residence, okay, you already own your primary residence and you're making really good money and you have disposable income, the same concept applies to you, right? All the time. I have people, reading about the BRRRR method online and all this stuff, and they, own their primary home. They own one property and they want to dive right into buying a distressed property, flipping it, renting it out, and then tapping the equity of the flip property, right? A really exotic or high risk real estate strategy they want to dive headfirst into. Let's take it easy, right? Take it easy, guys. What if we just simply upgraded our primary residence, right? What if the starter home that we bought, what if we just buy another primary residence, right? Because if you buy a rental property generally requires 20% down, right? It requires a lot more capital. But another primary residence, right? Generally, you put as low as, call it 5% down, right? So less money up front. You can upgrade the home that you're living in. You move to that new home. You rent out the current home. And before you know it, boom, right? That's a second property now in your portfolio. To give an example, one of my colleagues that I used to work with, very successful individual, very, very wealthy guy. They have a massive real estate portfolio. They have a massive real estate portfolio. I think it's upwards of 70, 80 properties, right? There's a lot of properties here. And I remember I was picking his brain on how he amassed this massive real estate portfolio. And he had described how his strategy was, I'd buy a primary residence. I'd try to buy a duplex. I'd rent out maybe one level of that duplex and I'd live in the other. And then I'd rinse and repeat. After a year or two, I'd go buy another primary residence. I'd put 5% down on that new duplex. I'd go live in that one. And then the old one that I was living in, I'd rent out the bottom floor that I was living in, right? Again, I'm not saying this is the exact setup, but something along those lines. And he'd rinse and repeat. And so before you know it, he has 4 or 5 duplexes in his portfolio. Before you know it, there's capital appreciation in those duplexes. Before you know it, he's starting to tap the equity of some of these duplexes and using that money to maybe invest in other ventures. Fast forward, call it 15 years later, now they have all these properties in their portfolio, right? So I'm not saying to emulate this strategy. I'm not saying I recommend it, but you get the idea that it was a slow burn. It was a slow burn to get to that point. You don't just become a multimillionaire with exclusively real estate from day one, right? The power of leverage, the power of just investing, period, requires patience. And what's really important if you're going to venture out into this, right? We've talked about some basic things, right? Just starting with your primary residence, maybe just simply upgrading your property, right? You don't have to dive immediately into all the exotic stuff. Is that you need to, again, understand those risks, and you need to understand how to play the game. So if you're going to venture into this, again, take baby steps. Look at your balance sheet. Look at your balance sheet. And what I mean by that is look at your savings. Okay. So here's what I mean by this. There's tons of generic advice out there that say that if you're really young, right, if you're in your 30s, early 40s, late 20s, that you should be investing 100% in stocks and be very, very aggressive. And that the only cash that you should have on hand is your 3 to 6 month emergency fund, right? So there's a couple flaws here with that. Number one is, what if you want to buy your dream home? What if you want to buy a rental property? Heck, what if you want to start a business and that requires money? But all your money is tied up in the stock market, right? Is that a very effective use of your resources, right? Doesn't sound like it, right? If your goals are to do this and your money is not helping you accomplish that goal, then you should do something about it. Another example is the folks that are crazy about putting every last dollar that they have in their name into a retirement account. And do not get me wrong. I'm a huge proponent of maximizing and utilizing employer benefits like 401k plans, right? Deploying strategies like mega backdoor Roths, right? I'm all for that. But at the same time, If your goals are to start a business, buy a property, whatever it may be, well, then tying up all your money in retirement accounts isn't going to help you do that. Because all you're setting yourself up to be is somebody who walks in the office at 55 years old and says, hey, I have $2 million in my 401k, but I only have like $50,000 in checking. I know I'm worth $5 million, but I feel broke. I know that sounds crazy hearing that, but people say that. And it's because they did a very poor job optimizing their balance sheet. So the reason why I bring this up is that if you are going to take this path into real estate, into venturing into properties, or whatever it is, you need to have the capital and have a good savings plan to get there. You need to be careful with generic rules of thumb. And one final one, right? The 3 to 6 month emergency fund. If you're, venturing into rental properties, you might need to have more cash on hand just in case there's a leak that needs to be repaired, just in case your tenant decides to leave and you don't have anyone paying you rent for 5 months, right? You perhaps need to have more cash on hand to mitigate that risk. And if you're not, then maybe this is not a good idea, right? I think the reason why so many advisors, so many people online, there's communities dedicated to being very anti-real estate and only investing in index funds is that all that is very simple. All that is very, very simple. Yes, all that is, there's simple ways to accumulate wealth. But if we're trying to get a little bit more advanced, trying to potentially unleash the tax potentials of real estate, then we're going to have to challenge ourselves a little bit and think outside the box. Finally, and this is the last piece of advice or guidance that I will give you on this, is to think like a CEO. And here's what I mean by that. The CEO of a company, they're the visionary of the company. They're thinking out into the future. They're envisioning what the company should look like. They're envisioning how to innovate and also the potential risk on the sideline. They're at the top of the ship looking out for the proverbial iceberg ahead. And if they see that iceberg ahead, how to mitigate the risk of that iceberg and get out of the way, right? You need to be the CEO of your own life. So you need to think ahead, right? If you're thinking about getting into real estate, envision the risks. Think about the risk. A lot of people talk about the rewards and highlight the rewards and all the good that comes with it. But what are the risks? What are you not seeing ahead of yourself? Maybe that means consulting with a trusted professional, right? Consulting on someone who's effectively your CFO to help you see what you're not seeing, right? Again, you have to run your financial picture just like you're a CEO. And if you run it that way, if you run your life that way, if you run your finances that way, I promise you, you're going to think ahead of a lot of issues before they pop up, right? Because that's the big thing with real estate. If you're going to do it, it requires very, very, very diligent planning. So guys, again, the purpose of this episode was to be really a primer to get you started on what to think about if you are going to start investing in real estate. If you have content that you want to see, by all means, go to our website, www.modernwealth.com. That's mdrnwealth.com. Contact us. Let us know what content you want to see. If you want to see an episode specifically on real estate taxation or whatever it is, by all means, let us know. We'll put together an episode for you guys. I hope you found this helpful. Like and subscribe to our podcast if you are wanting to be updated when we release new content. Subscribe to our weekly Planning Insights newsletter. Again, it was a real treat chatting with you guys today. I hope you have a great rest of your day. Take care.